Welcome everybody to the 9th lesson, the last of the lessons in our beginning options classes. And this one is about technical charting. We're going to go from some basics to some advanced features such as Fibonacci's. I'm also going to give you at the end of the session a real fast run through of taking a chart from basic chart on the platform without any lines on it all the way through some trades. So a good example. So let's start out with a little levity. You can read it, but I'm going to read it to you. Lessons in investing. You should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. That's called technical analysis. I'm not going to do that. Good, because it doesn't work if everyone does it. This is kind of what technical analysis is all about. It's a poke fun at type of situation. Folks, technical analysis works because other people look at the same stuff. It's a psychological game. Yes, it looks at the chart patterns and the candlesticks, and all of the stuff you see on a chart as something that's going to give you that holy grail of what's going to happen in the future. It doesn't. What it does, it gives you a look in the rear view mirror. What has happened in the past can, C-A-N, happen again in the future in the same rhythm or rhyme, but not exactly to the same latitude, longitude, aptitude, altitude, whatever you want to use for a tude. But when people look at moving averages, trend lines, Bollinger Bands, crossovers, types of candlesticks, when everybody's looking with the same definitions and reactions are against those definitions en masse, you have the ability to use technical analysis for your prediction for a future price level on the chart, and therefore make a trade decision based on these past performances of stock prices. All right, so what are we going to do today? We're going to look at candlesticks. This is going to be class 101 on candlesticks. What are they? What ones should you be looking at? Some chart pattern, some clues from some of these. Then I'm going to go into the Fibonacci's, which I've talked about in my classes and my discussion of trades. We're going to go through the basics of Fibonacci's, how you can use them, how you can place them, where you want to place them, and what the criteria are. We're going to talk about some trade placement criteria. When do you get in? When do you get out? Determination of your expectations. How can you kind of systematize or put down on paper what your expectation for a movement could be? Stefano, the answer to your question, no. Not risky at all. Very good analysis on your part. I have not pulled the trigger. All right. So a couple of candlestick patterns that you might have seen and heard about. A doji, D-O-J-I, Japanese word meaning indecision. That's this. Let me turn on my, hold on a second. Where is my... There are my candles, and I want this pointer. All right. This is the doji right here, folks, this X, where you open, go higher, go lower, and close, and the close is nearly the same as the open. It's like an X on the chart. What does that mean? Well, it opened at one level, it tried to go higher, tried to go lower, but it closed at the same level. This can be on a minute, 5 minute, 15 minute, 1 hour, or 1 day. It's just traders didn't know what to do. They came in at one level. They pushed it higher at one level. They pushed it lower at another level. And they exited that period at the same price as they entered. So this is the doji. This is really a bullish doji because we've got downtrend, stopped the downtrending move, and couldn't decide what's going on. Here's a bearish doji. Trades higher, 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 whoop, and all of a sudden, the brakes are put on. Enter the trade, tried to push it higher, couldn't, tried to push it lower, couldn't, exited the trade. Statistically, the next candles are down from here. Statistically, the next candles are up from here. There's another type of doji, also called a dragonfly doji, where you open, it doesn't go up, it takes a big look below, fails, comes back right to the opening price and closes there. This one is a bullish. That's why it's right next to the bullish doji. This is a bullish formed dragonfly doji. Tried to go up, didn't make it. Tried to go down, didn't like getting back into this candle, came back here. Next candle is typically an upward moving price candle. Then we've got what's called a gravestone doji. Just think of somebody in the cemetery. Opened, tried to go higher. Oh, I don't like it up there. Got killed and came back down to where it opened. Statistically, the next candles are to the downside. As it says at the top, they have sentiment when you take it in context with prior candles. On a doji, look back a few candles. Tells you which way the next move should be. All right, topping tails, stars, inside candles, you'll hear a lot of this. These are what are called reversal patterns. They give you a clue as to the ending movement on this time frame that you're using. All right, this one's called a spinning top. That's what it looks like. It opened down here, went higher, did a look above, came back down, did a look below, but ended right here. So you opened and you closed. It's a doji that's expanded, so it's a spinning top. This type of candle, being a bearish candle, I'll tell you why, is because the tail on the bottom is much larger, 2 times larger than the tail on the top, or wick on the top. The push above saw a lot of resistance. The push below didn't see as much. And the close with a followed down candle gives you a bearish signal for resolution to the downside. Same thing with this, what's called an evening star. This one is separated by the candle before it and by the candle after it. There's no price that is mated to this candle at all in the prior candle or the subsequent candle. Thus, it's called an evening star, something that sits out there in heaven suspended. This one's called a morning star, just the reverse. All right. This candle, as we came down in price, we did a big drop down, no equal values from this candle to this candle, and then the resolution candle on the other side of it is to the upside. These reversal patterns are best case scenarios. You won't see them exactly like this. Just be aware that they may form, this may be a rollover type of situation. This may be a rollover type of situation. This might be a reversal situation. Stock's going up and all of a sudden it starts going down. Up and starts going down. down and turns around and starts coming back up. So they're called reversal patterns. Now, we also have ones that are called engulfment, or one candle is inside of the other candle. Price is coming down. We have a big candle to the downside, but the following candle starts below the prior one, goes above the close, and continues to close higher. This candle is totally gobbling up or engulfing the prior candle. This is your indication of a higher move coming. Same thing happens here. Here's a bearish one. We're going up, and the next candle engulfs or gobbles up the one prior to it. You can see the close, the open is much higher. The close is much lower. So we're going, and a big whoosh could come to the downside. Two candles that Brad on the ShadowTrader show talks about a lot are called haramis. Harami. Harami in Japanese means pregnant. Just think of mama and baby. Mama and baby. A bullish harami is when the stock is coming down, down, and down. It's made a big candle, and the next candle sits inside of this big bearish candle. Sellers have dried up. Buyers are looking to find some good value location. Therefore, this harami candle that the cursor's on is inside of the prior one. On the flip side of the coin, we're going up, up, and up, have a big bullish candle, and the next candle is smaller, and inside of this bullish candle, here we've got buyers drying up, sellers trying to look for a good short situation. Statistically, this moves to the downside. Statistically, this has a push to the upside. So there you have your engulfing pattern. Now, we also talk about hammers. Big tails either to the bottom or to the top, with bodies with no tails on the top. So these are hammers. Remember, here's the handle, here's the hammer. Both of these are bullish hammers. A reversal signal. Stock is coming down. We've got a big look below and fail. Resolution typically to the upside. Stock is going down, makes a big look below, and then recovers, but it's still bearish as a candle. The resolution is typically to the upside. Going the other way. I drew this wrong. I'm going to have to correct this because this is wrong. No, it's not. It's right. I've got this right. Okay. This one's a hammer. This one's a hanging man. Hammers on the way down, hanging man on the way up. Rising, 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 go up to highs. You can see there's no wick at the top, but we close right up here. But we've got this long wick or handle at the bottom. Typically, this is the end of a move. Same thing happens if it's a bearish candle at the end of the move, either bullish or bearish. These are the end of a move on a bullish trending stock. How much time is there in between each candle? Carlos, these I took off of Bukowski's book about candlesticks, and I used daily bars. I would say that if you're looking at any of these, 3 days prior to 4 days prior gives you higher odds of being on the right side of a trend reversal or a confirmation of the way the trend's going. But as this market has been so time compressed, I would go as little as 2 prior candles to the one that you're looking at, like in the doji, go this candle and this candle, or this candle and this candle and this candle, 2 prior to validate the doji. On the reversal candles, I would have to see at least 1, 2, 3 candles prior for reversal. Current candle, -1 day, -2 days. On the engulfments, you can do it off of the prior day. But note the trend to this engulfment candle. Downtrend, small one, engulfed. Uptrend, small one, engulfed. Downtrend, big trend, engulfment, or harami. So note the trend prior to the candle that you're going to look at, prior to the candle that's giving you the signal. All right. Going beyond candles, we've got wedges, we've got triangles, we've got head and shoulders, W patterns, M patterns, all sorts of things out there to confuse you about which way the stock is possibly going to go. Here are 4 that are major patterns. We've got a symmetrical triangle. The downtrend and the uptrend are almost equal and at the same angles. They come to a point. It's a reliable type of pattern. Ascending and descending triangles. I've talked about those in our trades. Traditionally bullish and bearish type of signals that you want to understand. Then we've got head and shoulders. Talked about a lot, misused a lot, misdiagnosed a lot. And the statistics for resolution to which way it goes is not that it's not that great on a statistical basis that you can say, oh, it's a head and shoulders, resolution is this way or that way. It's nearly hard to peg it down to a high statistical resolution. Then triple bottoms, triple tops, just be aware of those. So let's go through these 4 major patterns. All right, asymmetrical triangle. You've got a stock trading like we saw with Visa, to the top, to the bottom, to the top, to the bottom, to the top, and your uptrend and your downtrend are fairly equal in angle and in number of touches. Usually it's an indication where investors are unsure of what the price is going to do for the next few days, few months, few weeks, whatever, or minutes. So they're just tightening down the noose to get it to a much tighter valuation. Bounce it up, too expensive. Bounce it down, too cheap, too expensive, too cheap, too expensive, too cheap, too expensive. And it gets down to this apex. Then they have to make a decision. That's where you want to be, is when it breaks out closer to this apex than I would say this breakout. As close as you can get here, the breakout is going to be explosive. But once the pattern is broken, the real price movement begins. On a symmetrical triangle, when you have a breakout, all right, this is bullish, but you're going to want to watch this high. Remember, high, lower high, lower high, lower high. I've got to break above this high to confirm that the breakout is going to continue back to the upside. So again, Once the pattern is broken, the real price movement begins to be evident. Now, other triangles out there. Flat top, flat bottom triangles, ascending and descending as they're called. This is an ascending triangle. Goes to a high, comes back down to a low, higher low. Goes to that equal high, comes down to a higher low. Goes back to that equal high once again. Breakout here can be sooner because you've already taken out one top, two tops, third top. The breakout is a triple touch, and the breakout couldn't be traded much sooner. On the descending triangle, all right, downtrend, flat bottom, you go down to a low value, bounces back up, lower high, equal low, lower high, equal low, and all of a sudden it breaks out of this flat bottom. Then this sets up for a bearish trade, and your entry can be very close to or soon after that break of the triple bottom touch. Thank you, Eric. Yeah. I will tell you, let me stop here and give you a hint. When you're looking at your charts, I would start with the 50,000 foot level, and that's a monthly chart, to try and find those areas of horizontal support and resistance that are evident back over a year. Once you kind of have those, put them in light colored lines or light colored lines. Go to the weekly chart, see if they hold water. If they do, then fine. Go to the daily charts and then start drawing your trend lines and your other aspects. But if you go from monthly to weekly to daily, you'll then hone in on better signals to start your trades. All right, let's take a look at this head and shoulders. The most egregious and misdiagnosed pattern on charts, because this one is textbook, where you've gone up and you've come back down. You've gone up, you've come back down to the same level. You've gone up, you've come back down to the same third touch. So you got a shoulder, you've got the head, and you've got a shoulder, but this is called the neckline or support. It's equal all the way across. You don't see this. This is not typical. This is artistic. If it happens this way, you're lucky. This neckline could be tipped this way, or it could be tipped this way. Just understand, if you've got three valid lows where the stock the price has bounced off of, look for this pattern where you've gone up, come back down, gone up higher than the shoulder and come back down, then gone up to another shoulder level. This high over here should be very similar to the high over here. Now, here's one thing on this piece on the right, pattern height. The amplitude or the distance from the neckline or this low that bounced to the head is here. Statistically, the break below this neckline is going to have the same amount or same amplitude to the downside, or what's called a measured move. That would be your target on a move to the downside. I'm going to read the bottom paragraph for you right now. Head and shoulders pattern is a prevailing pattern among short sellers. They profit as it breaks below the neckline. after 3 peaks, 3 stock plunges, so you've got 1 peak, 2 peaks, and 3. 1 is lower than 2, which is higher than 3. This offers what's called textbook break to the same amplitude as from these triple bottoms to the top to the downside target. It's a target. Don't let it get in your way. Carlos, Boeing you're asking if Boeing is a good example of this head and shoulders. Let's take a look at that at the end of the class. All right? I'll write that down. Thank you for asking. All right. Now, we've got the other side, the reverse head and shoulders. I don't like to use the word reverse head and shoulders. I like to use what's called a W pattern. Down to a low, found value, bounced up to a high level, returned back to the downside, double bottom, right? Then it returned back to the breakout level. So you go from 1 peak to a trough, to a peak, to a trough, right back to the peak. This is not, to me, a reverse head and shoulders. It's a W pattern. And here's why. Down, up, but where is the breakout? This is more difficult to find the breakout and where to play it. But as it says, you get the middle peak as your point to take the distance between this peak and the lower bottom troughs. Take that as the amplitude, and then take the measured mover, double it, and move it up here, so you've got a target. It's common as a reversal pattern. Come down to a low. Oh, bounce, right? You've heard of dead cat bounces. And oops, that's a little bit too fast. Then it comes back down. If it bounces at the same level, go back up to where it rolled over before. Use that as your target for a breakout. And as it says at the bottom, don't panic if the double bottom or the double top patterns don't develop as you thought. Sometimes they go up to that bounce point and do this again. So they go bounce, 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 bounce. So that leads us into the next one. You got triple bottoms, quadruple bottoms. W pattern, no breakout, back down, triple bottom, finally broke out. Same thing comes in, all right? You've got a trough to a peak. You've got a price differential. Back down to the trough, back to the peak. All right, your target was up here. It didn't do it. It came back down. Stopped at similar price and bounced back up. Third time, statistically, it will break out to this upside move. That's on a bottom pattern. On a top pattern, we go up to the top. Uh-oh, too expensive. Come back down to support. Back to the top. Back down to a similar support. Back to a top. Uh-oh, back down. Where's my area to enter the trade? Right at these triple or these double bottoms, which become triple bottoms. The distance between the rollover tops and these support levels is your target to the downside. All right. Now let's get complicated. Fibonacci's, what are they? Fibonacci is a mathematical formula or mathematical calculation for just natural occurring events. As it says, Fibonacci retracements are ratios between the starting point and the ending point that are naturally occurring, such as 23.8, 38.2, 62, or 61.8, 78.6%, and 100. By the way, a 50% fib that is not a Fibonacci number. 50% fib that you hear us talk about is not a Fibonacci number. It is what's called half back. We use it here on ShadowTrader incorrectly. It's not a 50% fib. It's just halfway between the bottom and the top. There is no 50% Fibonacci. Here's a look at how you can look at Fibonacci's. You can use these to your advantage. Stocks move in a cycle, up and down and up and down. Nature moves in a cycle. Winter, spring, summer, fall, day to dawn, dawn to noon, back to dusk, to overnight. Flowers open and close. Our body is set up with a Fibonacci. From the bottom of your feet to the tip of your fingers is a 100%. So 0, 100. Your waistline is typically 61.8 distance between the bottom and your head is 61.8. To the middle, your torso is 38.2. Your shoulders to your head, 23.6. So our bodies are made up of these percentage portions of 100%. Also, stocks are in a cycle. Now it says there, this is dated, but that's okay. If you go back to the market lows of the crash in 87, and you see where the 2009 bottom was, after correcting from the 2007 top, it's a Fibonacci. Here's 89 low. Here's the 2000 top. Here's the 2003 bottom. Here's the 2007 top. Here's the 2009 all-time low. And here, this goes out to 2014. But there are, if you draw a Fibonacci from here back on 89 to the top, this sets up for Fibonacci's nicely. A lot of the charts that I show you, that you'll hear from other people, use Fibonacci's. Here are the basics, how to set it up. You need to look at the last movement. So determine where the last or the most recent run in the stock price has been. Wait for a swing high or a swing low. What is that? Swing high. You're going up, you're going up, you're going up, and all of a sudden you go up, and then you start going down, 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 down. This candle right here, that's bookended by one that's lower on the left and one that's lower on the right. This is a swing high. All right, as we go down, down, and then we reverse and we go down, we start to come back up. And this is where it came from. This is the swing low. So you can draw a Fibonacci from this point to this point, all right? So you've got Fibonacci's from here to here using the Fibonacci tool. All right, I'm going to erase that because I don't want my lettering all screwed up. So on the Fibonacci tool, and I'll show you how to do that. So you wait for that swing high and the swing low to form. Again, can be daily, can be 15-minute, can be 1 hour. It does not matter, folks. They will all calculate the same way. All right, later on, I'll show you what the Fibonacci's look like. In a bullish trend, you're going to look for the Fibonacci's to show you where pullbacks are. So you draw the Fibonacci from the low to the high. That'll give you where the pullback levels are. In a bearish trend, you're going to draw from the Fibonacci, from the swing high to the swing low, and that's going to give you where the bounce levels can be. You always draw Fibonacci's using the wicks or the tails. All right, here's an example. Stock has been advancing, so here's your low. This is a swing low. See this bar? The one before it is higher. The one after it is also higher. This is a low. Here's your high. One after it, before it, pardon me, is lower, and the one after it is lower. So take it from low to high. This is on a bullish run. So you want to see how far back it can pull. Here's a 38.2. Here's a 50%, not a Fibonacci, but half back. And here's 61.8. By the way, the 61.8 is called the golden ratio. 2/3 to 1/3. So if you drop to the 50, your bounce back first hit would be here. Then there's a Fibonacci in between this. So these are going to be your pullbacks to here, pullbacks to here, pullbacks possibly to here, but bounce points as well as we go forward. Once a pullback starts, you can identify that 38.2, that 50, that 61.8, where prices should find support. You saw that on the SPY chart that I showed you before. Go back to the beginning of this replay and you'll find that. We'll take a look at that at the end also. All right, and here's one that we start from here's a bearish trend. Now we want to see when this ends. So we take the high to the low. We start from the low and go to the high. We want to see how much it can bounce. So we draw the Fibonacci here from our declining end to our declining start. We've got a 38.2. That's a bounce of a 38.2. Went to that, backed off. Went to the 50%, backed off. Next target to the upside for a bounce is the 61.8. They're used to identify the end of a correction or the start of a retracement. While 23.6 is used, Brad and Peter do not use it. They use 50 and 61.8. I throw them on because they are valid Fibonacci's. They give me some additional clues. The best one to use, 50, 61.8. Golden ratio at 61.8, 50% is half back or middle. All right, so that's a quick course in Fibonacci's. Let's do this. Projecting a valid price for your time horizon. Expectations for a movement and therefore a profitable trade. How do I pick out where this stock can go? Where do I get my number? Do I get it from thin air? You can get it from analysts, or you can do this. You can take the earnings growth percentage point or percent, its current price, analyst targets. You can come up with discounted cash flow, whatever. Pick a number for your expectation of price. Put it on the chart. Expand your time horizon and put it on the chart. Put a little dot or put a note as to what your expected price is. Now you need to decide when it's going to reach that number. How do you do that? I've shown you this ATR, average true range. How much does a stock typically move in a day? So if you're $5 above your price and the stock moves $2.50 a day, it could do it in 2 days. It also could do it in 2 weeks. Go by the way that the stock is trading. Is it moving stepwise to the upside, or is it going by chunks? Is it dribbling to the upside or downside, or is it, as I said, is it jumping from price to price to price? This should give you some idea of the time frame that you can use. It's not a science, it's an art. Now, on your price expectation, does your projection make sense for what you're looking for? Are you looking for a $10 move in 2 days? Does that make sense? Maybe, maybe not. Are you looking for a $10 move in 2 months? That might make more sense. Can you see a pattern that happened in the past, in the last 2 months, 3 months, 6 months? It says 2 years, but let's be realistic, 2 to 3 months. Is there a repetitiveness to that pattern that you can then say, all right, this one lasted 5 days and then it rested, then it did 5 days again and rested, something like that, and then project that forward for the same type of repetitive pattern. Here's a technical checklist for you. Is the price pattern or trend in your favor? Are you trading bullishly on a bullish trending stock? Is there volume confirming that the trend is going in your favor? What's the tone or sentiment of the market? Is it in your favor? Taking a look at weekly and monthly charts. Are you going against the monthly and weekly trend, or are you going with it? What are the moving averages doing? Lots of people look at those. Other indicators, do they confirm or invalidate what you're looking at? The last one is Bollinger Bands. We haven't talked about that, but that's an indicator that gives you a 2 standard deviation range around the stock price. I will show them in the example that I'm about to get to. All right. How about pulling the trigger on the option trade? Does the time frame work out? Time is the one thing that you can't buy enough of for your trades. Are the strikes valid? Do they make logical sense? Is the option trade fairly valued? Try not to overpay on the price of your option trades. The bid-ask spread, the difference between the price that you could buy it for or sell it for, is that conducive to the trade? I call it the hurdle rate or the haircut that you have to take if you buy it and then all of a sudden you turn right around and sell it. It should be less than 8% difference between the bid price and the ask price on your trade. Is implied volatility in your favor? Are you selling as implied volatility is declining? Are you buying as implied volatility is rising? Stick to your conviction of your setup until it invalidates what you thought was going to happen. And here's one. Let the price come to you. Don't chase a trade. Just because it is going upwards or downwards in price and you're looking at a bullish or bearish trade, don't go scurrying out there just to buy the option trade or the stock itself, because it's going to get away from you. It's going to get you in trouble. Shiny, bright objects have a way of turning around and biting you in the patoots, in the butt. All right. Conclusion, price and trend match your expectation. Time frame matches your expectation. price pattern awareness, a good entry point from a trend line, from a support level, a resistance point, a moving average, fair and reasonable pricing. And when do you exit? Set yourself an exit number. Be it return on investment or return on risk, use a percent, not a dollar amount. Use the percentage, people, not a dollar amount, and you'll do much better in trading. All right. I'm going to go through quickly an example of how you set up from a raw chart, just one that you see on your screen without anything on it, to some trades. So you start with a raw chart. All right. Then we add in some moving averages. Here I've shown you the 5 and 20 exponentials. I don't care what you use. Use the 20 and 50. It gives you some context around what the stock may be trading around. In this case, this stock, the 5 is in red. It looks like it wants to trade around this 5-period exponential moving average pretty well. Yeah, it's 5 days. Now, put on some trend lines, support and resistance. Again, start with the monthly, go to the weekly, go to the daily. These are ones that you use a point here on the right and look to the left for your support and resistance. Is it valid? Here's one, 1, 2, 3, 4, 5, 5 touches. Valid point. How about this one? Yep, 1, 2, 3. Well, I'll look above and fail, look above and fail, 4. Here's another support resistance point. Many times it got down to that. Trend line. Breakaway, take the first touch. After that breakaway, that got to this. You can extend it out. It invalidated here, but came right back to it. Did a look below and fail. Still good, still good. Now we've got an invalidation on this trend line. All right. Channels. This is a channel. There's a trend line. There's a channel. Change in trend. All right. I've expanded the date out here to encompass this. E means earnings. This one has a date expansion on it, a downtrending wedge, and an uptrending wedge, all in the same chart. We had a double bottom, boom, 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 double bottom. Well, really, 1, 2, 3, triple bottom. Trend reversal, big question mark. Got to wait for the next candle. And we've got earnings coming up. Reversal, all right. This prior one, we were here on the 13th of January. Well, 13th of January was back here. We did a look below and fail, and back above the trend line. So it crossed back. This is a reversal signal. Double bottoms, going back up, coming back to our moving averages. So I've got a move back to the upside. Other indicators here, RSI moves from below to the 50 and above it. MACD, moving average, went from negative to positive. Buy point, yeah, well, buy point, but I've got this earnings coming out here in the near future. This becomes decision time. Do I exit my trade or do I scale out? That's a decision that you've got to put on your trade setup. All right, earnings has come. Earnings is upon us. So you're not going to see this, but earnings has come. And I'm profitable in the trade. Do I take it off? Do I buy insurance like a long put and ride over that? That's a decision you should make. In this case, earnings were not that bad. In fact, they were good. We went up, we came back down, tested that, and moved up. This one exited the trade as it says here, upper Bollinger Band was breached. That's this thin blue line. That's 2 standard deviation move. Stocks have a tendency, once they're outside, to come back inside a 2 standard deviation move. We also had RSI overbought, MACD starting to roll over, which means the trend is going from bullish towards neutral to bearish. That gave us an entry for a bearish trade. Here's a reversal. Target was down here. Continued to go. Came close enough to the target that we pulled the trigger and took the trade off. Then the stock decided just to grind to the top, to the bottom, to the top, to the bottom, to the top, to the bottom, to the top. All right, which way is it going to go? Multiple touches, could break out to the upside, could go right back down. We don't do these trades in the beginning option trades, but there are ways to play this choppiness. It broke out. It broke out to the upside, tested it, and then broke out a second time. Second breakout is now a buy point, trade entry. Continues on. Trade goes to all-time highs. Or post-earnings high, I should say. That's our target. Hits our target. We exit the trade. Continues to go. Oh, shoot. Continues to go. Couldn't find a suitable trade setup here. So we said, okay, we missed this one. We missed the trade. And the trade after earnings went well beyond what our expectation was. Train got away. Wait for the next train. Maybe next time.